Well, he says the U.S. is debasing its currency and that no one has the courage to do the right thing when it comes to the deficit. But what is the broader impact in the near term and the long term for investors? David Tice, Federated Investors Chief Portfolio Strategist for Bear Markets, joins us now from Dallas. I always like having you on because you say exactly what you think, David. And let's start with that thought that no one has the courage to do what you think is needed to deal with the deficit.
Yes, unfortunately, Poppy, our politicians have essentially just taken the stance of kicking the can down the road. And there's an election every 2 years, and we've gone for the immediate route of expediency and it's kind of like the hair of the dog remedy. If your friend is out drinking and you want him to stay out till 2 o'clock in the morning, you might give him another shot of tequila in order to get him to stay out till 2 o'clock, but he's going to feel all the worse in the next morning.
And you know, you've gone so far, David, as to say this is a Ponzi scheme, talking about U.S. monetary policy right now, what the Fed has done, trying to pump more and more, whether it's QE2 or keeping interest rates incredibly low. That is just not the solution for the long term. But my question to you is, what is the solution? What else could the Fed have done?
Well, frankly, the Fed would have been better off doing nothing, because essentially this is hard to deal with, and it's very possible we needed to do something during 2008 when the whole system was falling apart. But the excesses have got to be cleansed. And by doing what seems to be the humane thing and trying to do this Keynesian fiscal stimulus and trying to create demand with with this counterfeit money of QE2, we're essentially making it worse down the road. We're getting a short-term benefit, but it's not going to help us longer term.
How big are your concerns longer term, and what are we talking about here? Because as you said, the short-term benefit, the market likes this right now. I would be afraid to see what would have happened if we had no action from the Fed or if they increased interest rates. So what are you nervous about? 1 year out, 2 years out, 5 years out?
I'm very concerned that we are debasing the currency, that we will have significant inflation in this country, more than 10%. I'm concerned about stock prices falling below 5,000 on the Dow. I'm concerned about unemployment reaching much higher levels than what we have now. We'd be better off doing nothing and let the economy cleanse itself, because these short-term fixes don't help.
How do you grease the wheels then, David? Simply put, how do you spur employment in this country? We know that companies have plenty of cash on the sidelines. They don't want to hire. They're not willing to. It's an uncertain economic environment, an uncertain tax environment. How do you grease the wheels?
Unfortunately, what we have to do is we have to go down before we go up. More foreclosures have got to happen. We have to move away from this luxury consumer-driven market. And unfortunately, it's going to be painful. It's going to hurt a lot before we get to a recovery process if we do it the smart way.
We're sitting right below Dow 11,000. You're talking about seeing the index cut by more than in half. And you're saying gold futures are going to cross the Dow, maybe gold at 6,000.
Yes, I do believe in this kind of environment there's a ratio between gold and the Dow Jones Industrial Average. It's ranged from single digits to 45 in the past. When individuals love financial assets, the ratio of Dow to gold is very high. When they start to lose trust in financial assets and they lose trust in the currency, gold goes up and the Dow goes down. We think that the currency is being debased to such a degree, it's possible notional stock prices in terms of the Dow don't go down that far. Mm-hmm. Maybe they only go down to 8,000 or 9,000, but then gold goes up a lot higher.
What's a realistic valuation for gold? Because we have seen the run up. It's actually been holding back a bit over the last few weeks. What's realistic for gold, David? Because 6,000 doesn't seem anywhere near realistic.
Well, it seems unrealistic, but when you look around the world and the fiat money, which means money that's really backed by nothing, you see what's going on in Europe, you see the UK, you look at China, they have a massive bubble. You look at Japan and their massive amount of debt. We could easily be at $5,000 for gold.
Given all of this that you've pointed out, where are you advising your clients to put their money right now?
Well, we feel a lot better being short rather than long, which means you make money when the market goes down.
Well, what about the investor that doesn't want to look at their portfolio even every 6 months? Is there any safe long-term investment right now?
I think gold and silver mining companies, if you have to be in stock, be low risk. Try to invest in companies that have dividend yields that are selling at close to book value. But I think every individual should have gold, silver, and mining companies in their portfolio.